Principal of Community Design, and as of January 1st, I am your Ely Chapter President. So I'm honored to serve you. Our 2018 Ely Board met last week in a retreat fashion, so we have tons of new ideas. We're keeping all the good. We're improving on anything that wasn't. Stay tuned to hear about all of those details, but I am very excited about my board colleagues and the things we're going to accomplish this year. We also have new staff on board. I want to make sure Melissa and Brad are in the room. They're not. Hang on a second. You know they're busy at the front counter. Forgot to give them the old warning, but I do think it's important that you see them by face and get to know them. So we hired Big Buzz Idea Group, which is a Chicago-based firm. Founder and owner Melissa Legowski is here. And Brad Ball will serve as our executive director, so he'll be your first point of contact for all matters related to the Ely chapter. So thank you, Brad and Melissa, and welcome aboard. I'm always impressed by the sponsors who are generous, who open up and are generous with their money and resources to help us bring on the fantastic programming that we do. Those of you who have already signed on as platinum sponsors, I'd like you to stand as I read your names. Adrian Smith and Gordon Gill, Kinsey Real Estate Group, the Lakota Group, SB Friedman Development Advisors, and W.E. O'Neill. Thank you so much for being with us. Look at all these amazing gold sponsors too. We have Ansel Glink, Caban Van Ruben and Mayberry, DK Mallon, Farr Associates, Focus Development, Corals and Brady, SOM, and V3. A big thank you to our gold sponsors. Our silver sponsors, but I'm one of them as well. We'll get this rectified, but there are an amazing number of silver sponsors. If there's still time to sign up as a sponsor for 2018, we are bringing back things like the salon and the Chautauqua. These are the types of things that we need your support for. The events that either are perennial favorites or ones that we're going to make perennial favorites. Our hardworking committees are the ones who make these things happen. I should mention, membership committee has put out the call for nominations for new members. That is due February 9th. It's coming up very quickly, but that's the deadline that will help us get everything organized for the June initiation banquet. So put February 9th in your calendar. As I mentioned, we are bringing back the salon this spring. I only heard amazing things from folks who hosted salons in their homes and participants about getting to network in a different way and dig into some of the deep land economic issues facing our city and region, so we will bring that back. Land economics weekends, there's one coming up in April in Baltimore. So if you have an interest in either town-gown relations, harbor, redevelopment, TOD, or if you want to see Orioles play the Tigers, that's part of the agenda. And they're actually having Janet Marie Smith, who's a renowned urban designer who worked on Oriole Park and several other ballparks across the country, give us personal remarks about that redevelopment. They're also doing an interesting thing called a dine-around, which sounds like the salons, where LAI Baltimore members will open their homes for intimate dinners on one evening of the Land Economics Weekend. So highly recommend you sign up for that if that's of interest. I did see 19 of the 26 chapters will have representation. So if your work takes you across the country or the world, it's unparalleled networking in that way. And then if you haven't heard, Chicago is on tap to host the Spring Lou for 2020. So get thinking about how or if you might be involved in showcasing our city. I think 2009 was the last time we hosted the Lou, so there's a lot to show folks. We're going to be putting together committees, sponsorship, all of those fun things that go into the land economics. As we sent out an email, due to the record number of attendees today, we're not going to do the verbal intros as is our custom, but we hope you got a lot of value out of the list being sent out ahead of time. We think that's something we might make a regular thing. So with that, I'm going to turn it over to Leslie Roth, outgoing program chair, who will, no, I'm way ahead of myself. You know, it's my first time doing this, but we will enjoy each other's company, have lunch, and then introduce the speaker. Thank you, everyone.
You'll have something interesting to say. Without further ado.
Oh, Mary!
Hello, Chicago. My preparation for today's presentation included somewhere out there is Andrew Ewell, who was the project I was in support of in speaking before the Village Board of Oak Park, and was hissed in the process. So, as I was being hissed, it was during the reading of my credentials, which was a particularly galling moment. You would want your children to have gotten some of these degrees, and so I thought my life was passing before my eyes as I was being hissed during the reading of my credentials, and I thought of audiences like this that have come on a January day to hear me speak. So I'm honored that you came back despite the Village of Oak Park experience. Andrew, good luck with the project. I hope it's as good as you and I both expect it to be. There you are. So, once a year or so, I create a title for my various speaking engagements. This one I came up with in the fall, right? Who wouldn't in the real estate business? I think at this point, hurricanes and fires and floods, oh my, might need to replace location, location, location is how we describe the relevant drivers of real estate. What a remarkable year it has been on so many levels. And the opportunity to be here and talk with you as I try to think through and process what's going on, I am most honored to see all of you here. So I might do this with, how about this? We're going to walk around because I think I need to use the space bar to move on. I hit on this format a while ago. I think I can do this. Here we go. I feel like Carol Merrill. Let's make a deal. So I hit on this format of showing the relevant global actors in photographic form. And obviously, we have a man who loves his country, even if his methods of showing it are sometimes baffling. We have... Yeah, they're like, we're just going to let that sit, right? I will be taken down a rabbit hole if I respond to that. All right, we've got some fascinating global actors. The Rocket Man, I don't mean that in a disparaging way, I'm simply referencing the news. I think of him every time I go to Seoul on business, and that happens a lot. And now I can think of him from Chicago, given his ballistic missile reach. Keeps expanding. Vladimir Putin presides over an economy that's increasingly irrelevant, although maybe a little more so in an era of $70 on a gallon oil. But clearly what he learned as the head of the KGB is pertinent to hacking into elections around the globe. Xi Jinping, I always say about him, he is presiding over a country that's trying to get rich before it gets old. Increasing global growth has made that transition from a export orientation to more domestic consumption, made it a lot easier. It's had a pretty good run of economic growth and continues to be a dominant actor in the globe, especially as the U.S. steps back from foreign policy dominance. That little written work between the president and the president is the transition between quantitative easing and quantitative tightening. I'll talk more about that in a moment. But let me get back to where I started, which is for a long while, I've been focused on the environmental side of what we're doing when we make an investment. So my company buys real estate on behalf of pension plans, college and university endowments, and sovereign wealth funds, among others. And what the storms and the wildfires and the floods reinforced was understanding the risk not solely in the asset, but in the municipality in which it's set, Can they pay for the infrastructure changes that are going to be necessary as sea levels continue to rise and as more extreme weather events happening? Our clients have become increasingly aware of that, and I would just urge you all to understand what kind of exposure you are taking on in various real estate specific investments. So with that, let me comment on, this is going to be a little awkward, back and forth, but let me comment on the macro backdrop for thinking about commercial real estate. Despite the global geopolitical environment that's as fraught as any time in my life, and I do recall sitting on my mom's lap and looking at an edition of the Chicago Tribune where you could see the range of the Cuban missiles and where they could get to. It's a little bit of a flashback to that right now. That being said, from an economic perspective, this is the best economy that we've witnessed in a long time at the global level, and that has slopped over into the U.S. environment. Globally, the best since 2010, and that looks as though it's poised to continue. The globe remains the beneficiary of quantitative easing. The U.S. might have begun to tighten. We've had 4 rate hikes since the regime shifted from loosening to tightening. And as of October, the Fed began to allow the securities that it had invested in as part of quantitative easing. They began to start letting them mature at the rate of $10 billion a month. It'll take us 5 years to get anywhere close to reducing their balance sheet. But with that, there were those that expected that was going to result in the 10-year treasury, which is an important benchmark for thinking about real estate pricing. There was an expectation that there would be an upward surge in 10-year treasury prices. And that has not materialized, in part because of the global environment. With the German long bond, the 10-year bond in Germany, is still only offering a 42 basis point yield. And with that, the fact that the U.S. has been pushing up the short end of the curve, which is what it controls, that's what the Fed controls, it has not made a difference to speak of in the 10-year treasury. We could expect, though, that with the tax reform package that was passed, that will add to the deficit meaningfully, this could be the year, after how many years in which we've been expecting interest rates to rise meaningfully, this indeed could be the year where that finally happens. 2018 is looking good from the U.S. perspective, expected to see the fastest rate of GDP growth. Hello? Maybe we won't do that again. The U.S. is expected to see strong GDP growth. More relevant for the real estate people in the room, which is virtually all of you, is the rate of job growth. And there we're likely not going to see as fast a rate of job growth as we have in the recent past, in part because of the retirement of my generation, in part because we're largely at full employment and it's going to cost more to hire workers. So that has real estate demand implications. Maybe a softer period for apartment demand, for example, because apartment demand is driven by job growth, more so than GDP growth. Recession risk is low at this point. Moody's Analytics, whom I follow closely, they're putting recession risk, the odds specifically of a recession in the next 6 months, they put that at 4 to 5%. Sounds extremely low. But I think all of us that lived through the global financial crisis, and based on who I see in the room, that's virtually everybody, we're always going to be thinking about the next recession and how do we plan best for it. And for that reason, we are telling our clients, make sure you put some defensive strategies into the mix. That includes investment in debt. We are lenders as well as buyers of equity real estate. But it also means thinking about real estate as beyond the 4 primary property types, as this audience has heard me say many times, and thinking about inclusion of sectors that have demand drivers that are a little less cyclical. That includes senior housing, student housing, medical office, and self-storage. So with that, I'm going to dig in. Maybe I can move this up a bit. Oh, someone can click for me, that'd be fabulous. Thank you. All right, good. So you've seen this chart before. I'm plotting total returns in goldenrod, rust. What color is that, you architects? It's not my realm of expertise. What did I hear? Richard?
Orange.
Orange. Richard, I thought more. I'm going with goldenrod. So goldenrod, it's 1 year unlevered real estate returns plotted against 1 year real GDP growth. You can see 3 recessionary periods. Real estate doesn't do so well during recessionary periods as a whole, but look at here. This was the tech bust, highly concentrated downturn. In that instance, real estate behaved much better than it has in the past, in part because real estate investors took the recession as a moment to enter the market in a meaningful way, rather than standing by and saying, oh my God, we're in recession. I predict that's how we're likely going to see real estate investors behave the next time the macro U.S. economy turns down, in part because of the globalization of real estate investment, where the Koreans, for instance, the South Koreans were perfectly positioned. They've just made allocations in their portfolios to commercial real estate outside of South Korea in 2008, 2007, 2006. They were ready to pounce on Midtown Manhattan and the city in London real estate at a bargain, and they'll be back to do the same thing the next go around. That will bracket the extent of the fall in real estate returns and real estate prices. Over on the right, you can see that real estate is now behaving more like it should. There was a period of years where that goldenrod line was showing double-digit returns for unleveraged real estate. We're done with that period. Cap rate compression has happened. Cap rates are at historical lows. They continue to edge downward, but not much more room for compression there. And meanwhile, real estate value increases are being driven now by net operating income, which is under some level of pressure. Here we are 8.5 years into an economic recovery or expansion. The longest in post-World War II history was in the 90s, and that was 10-year long. But we weren't building a lot of real estate during the late 1990s, given how long it took for the real estate capital markets to recover after this deep depression in real estate values. So we're going to live through a period where we're going to see a lot more new supply being delivered, potentially in some locations, because of the duration of this period of economic expansion. It's happening in the apartment market, where what will stop the building in apartments is not a recession. It will be that rents will fall low enough that that combination of lower rents that are being underwritten in certain locations and higher construction costs is going to make fewer and fewer apartment deals pencil out, particularly in the center cities. More on that to come. Thanks, Brad. Next slide. Okay, you've seen this format before. I'll just explain it for those that are new to it. We're looking at supply, additions to supply, as a percentage of the existing inventory. Upper half of the chart, it's a melding together of deliveries in the 4 primary property types: apartment, office, industrial, and retail. And you can see the 20-year average, we were expanding the inventory by a rate of about 1.5% per year. However, over the last years, since the global financial crisis hit, the levels of new supply being delivered way under historical levels, but that's starting to change. And by 2017, we were pretty close to the 20-year average. Clearly, you're real estate people, you understand it varies by property type. So here on the left, this is the retail deliveries during that period of time. 2016 is the left-hand bar in each of the clusters. 2017 is shown, and then the stripy ones are the 5-year average and the 20-year averages on the right. Retail, the lowest level of new supply being added of any of the property types, logically, given how oversupplied we are in retail. By contrast, industrial, the darling property type of this particular cycle, seeing an uptick in supply relative to 2017 over 2016 by about 20%, and well over the 5 and the 20-year average. Completely warranted based upon the level of demand, but definitely a shift as the cycle has worn on. Office completions, 2017 will have been the peak for office. That sector is seeing a pullback in the level of new supply, and it remains under the 20-year average, as well as just a little over the 5-year average. And then apartments. Each year, you're going to see a slide in a second, each year we've thought we were hitting peak levels of apartment deliveries since 2016. And each year, it's the next year out that'll be the peak. Still anticipating that will happen in 2018, but we've been amazed by how much, it may take a developer 10 phone calls to get financing for a project versus the 1 or 2 in the early part of the cycle, but supply is still happening in a sector that, I'm sorry to say, is going to be, on a near-term basis, overbuilt in selected locations. Next up, Brad. Talking about transaction volume, before I get into some comments on individual property markets, this is the full length of the Real Capital Analytics time series. Goes back to the year 2002. The bars show full year transaction volume, with the exception of the far right-hand column, which is 2017. That's a year-to-date number as of November. If we compare that to year-to-date through this period, through November of 2016, it's down about 7%. There are a bunch of reasons why transaction volume has come off a bit. One of them relates to a shift in some foreign capital that has seized on an economic recovery that's more robust right now in Europe than in the US. Europe, the European Union, had a faster rate of GDP growth than the US in 2017. Truly remarkable. And that has meant there's been a shift in global capital to weight opportunities in Europe over opportunities in the US. That's a part of this. Another part is that sellers of property have been used to it being a seller's market in the US for the last 4 or 5 years. They put an asset to market expecting it to sell here, and for the years leading up to last year, often prices that they actually got for their assets exceeded expectations. That was not the case during 2017. And because of the loose and highly available financing, real estate owners that didn't have an urgency to sell were able to simply refinance, as opposed to going ahead with a sale at a level that didn't meet their anticipation. That has not translated into an uptick in yields. Instead, the yield number averaged throughout the year ended the year at a little bit over 5%. Again, a historical low level. But there's a lot of nuance within that. That's an aggregation across multiple property types. What we are seeing is a continued downward pressure on yields in the favored sectors. That includes the defensive sectors like medical office and self-storage, and as well warehouse, which institutional investors in my realm can't get enough warehouse into their portfolio to meet their demand, and that's resulted in a continued pressure on yields, upward pressure on price. By contrast, apartment assets, not a lot of trades during the year 2017, but there definitely appears to be instances where there's going to be upward pressure on particularly luxury apartment yields as a result of near-term oversupply in some locations like New York City, San Francisco, Denver, and Chicago. Next slide. There's a great deal of capital still focused on buying in the U.S., and that's going to be evident in the year 2018, which is shaping up to look as though we're going to have a higher level of transaction activity based upon the properties that have come to market thus far and the investor interest in them. Clearly, it's early days, January the 17th, but it looks as though there will be more to buy in 2018, and part of the transaction environment is you can't buy it if it's not for sale. So this is looking at capital available to invest in commercial real estate, and this is Preqin data, and it shows a steady uptick. Even as some foreign investors are looking elsewhere, U.S. investors are upping their allocations to real estate by and large, and global capital is still interested in the U.S. They're just not seeing it as a bargain relative to the recovery story playing out in Europe. Next slide. The dynamics are starting to shift in how individual property types are behaving at the national level. This is net operating income, same store, so we're looking at comparable properties year over year. And the dynamic is that in the upper right-hand corner, I show you the 20-year average net operating income annual growth. So industrial, the lowest on that basis at 2% annual rent growth, but it continues to clock its historical levels as occupancy is now at a historical high or close to it for industrial, and you're still seeing significant rates of rent growth. So it is the clear outperformer as we shift in how and what we buy, how, where, and what we buy. Meanwhile, retail under pressure. Retail's the purple line, and it historically has seen the second fastest rate of NOI growth over a 20-year period, but it's under pressure now. We're experiencing this as a lease rolls in our retail properties, be they open air or regional malls. We buy the best of the best. These are the assets that will be the survivors in this curious retail time. But there, it used to be a great moment when a lease expired, you could raise the rent. Now today, we're hoping to get flat rents and likely going to be hit up for higher capex than we would have underwritten 3 years ago. Office, little uptick there. That's partly about a recovery in some suburban office locations. And then finally, apartments, the green line, apartment NOI starting to come down as occupancy has hit a peak and the rate of rent growth is slowing. Clearly, these are national numbers. They obscure a great deal of nuance. So I'm going to try to move into a more nuanced view next. Starting in the apartment sector, the format here, the blue bars are the deliveries in a particular year of, these are apartment properties only. Axiometrics is the data source. That's contrasted with net absorption and then the net result in yellow. What do you think? Richard, you get another chance. Is that yellow? Can we do better than yellow? No, we're going to stay with yellow. So what you can see there is occupancy peaked in 2015 and has been coming down, not meaningfully, but it is showing that in a sector where you typically can manage your occupancy by adjusting your rent, there's enough new supply that there's downward pressure on occupancy. That's very situational though. We're finding suburban markets holding up better right now than center cities, only because, well, there is demand in the suburbs for one, and in the downtowns you have demand growth, but supply being delivered at rates that exceed healthy levels of demand growth. So this is just a simple instance of there being a lot of supply outpacing the rate of demand growth. Next slide. This is quarterly deliveries plotted against effective rent growth, and you can see that very sweet period in 2015 giving way to above inflation level rate of rent growth, but obviously well off peak levels that exceeded 5% at the national level. I'm showing you a forecast for deliveries through the end of last year. Looking ahead to 2018, Axiometrics is expecting about 360,000 units to be delivered in the course of 2018, which is up about 12% year over year. Looking as though 2018 will be the peak and we'll start to get some relief, but I've thought that before, as I noted earlier. Next slide. Getting to individual markets. These are metro data, so they're obscuring this different dynamic between center cities, which by and large are under pressure from a rent perspective, and suburban markets like Oak Park that are experiencing good rent growth still. The format here is the blue bar is showing you the year-over-year rent growth as of September, and that's compared to the green line, which was peak rates of rent growth for each of these metros. Here's Sacramento, still getting good rent growth, 6%, but well down from the 8 or 9% it was experiencing. Riverside County is next. This is Las Vegas, one of the housing boom, housing bust markets finally seeing a recovery. It's pretty much matching its long-term average. Orlando, the Florida markets have held up pretty well. Orlando's still seeing strong job growth. Phoenix, coming back a bit. Here's Seattle, despite remarkable amounts of new supply. Seattle is still holding up, relatively speaking. Amazon, clearly what happens with HQ2 could affect the ability of Seattle to absorb as much supply as was being delivered. I'll jump over, here's Minneapolis. here's Boston, here's Chicago, and that is, we're showing a real slowing in the rate of metro effective rent growth for apartments. Broadly speaking, downtown flat, while suburban settings are seeing faster rates of rent growth. And then Austin, beset by new supply, seeing actual rent declines, and New York City, similar dynamic, where rent growth flat year over year. New York's supposed to be a market where it's hard to build, and that was a protection. It shifted a lot of REITs to only hold apartment properties in hard to build locations like New York. What this cycle has proved is hard to build does not mean can't build. And there are settings that are seen as NIMBY locations, the suburbs, as Andrew Ewell well knows, really hard to get through. By contrast, center cities have been far more about yes in my backyard, seeing the economic development benefits and being quite welcoming of apartment developers. And it's led to a setting of near-term imbalance in these markets. That supply is going to get absorbed for sure, but in the short term, rents are likely going to disappoint. Next slide. This you've seen before if you've come to one of my talks. This is looking at the dichotomy between the increases in supply for urban areas here in that goldenrod color, plotted against the blue, which is suburban areas. The urban settings seeing significant expansion in their supply. A lot of that is warranted. Let's just talk about our fair city. Downtown Chicago's population has increased in the period from 2000 to 2010, it increased by something like 48,000 people. Another 22,000 people added over the last 7 years. Meaningful increases. We just, as a sector, know how to overbuild meaningful increases in demand, and we're doing it again. Next up, retail. Okay. Thank you to Emmy Adachi and Jen Wickman, who are with me today, for being my stalwarts and giving me the nuance in an immensely complex property type. Here are some things you should know. First of all, retail is in an era of massive disruption, but it is not solely e-commerce and mobile commerce that is changing how retailers are performing and how shopping centers are performing. There are other dynamics that need to get called out as well. They include the fact that we all have this ability in our hands to compare price. That's meaningful. We also have a dynamic that has been ignored, but the rise of the discounters. Jen and Emmy put together a chart that I'm not including, but I'll tell you the punchline. It shows department store sales as a share of total retail sales, Census Bureau data, over a 10-year period, roughly. And over that time, department store market share as a whole has stayed roughly constant. But it's the split between the mainstream department stores, a la Nordstrom and Macy's, and the discounters. Discounters like Ross Dress for Less, Saks Off Fifth, Marshalls, TJ Maxx, the treasure hunt retailers, they remain very strong, while it's the mainstream department stores that have lost market share. So that's really important for those that believe that we will only buy online. The success of TJ Maxx and Marshalls as a company is a testament to the fact that there is a role for the in-person experience, the treasure hunt aspect of it. There are changes in demographics that are underway. Millennial generation quoted as the group that wants experiences over buying things. Well, not so much, it turns out, if you dig into the data. And I would just argue, as I often do in talking about generational comparisons, there was a period in my life where what I was buying was experiences over goods. But I gave that up when I had kids, and that will be the experience of a lot of millennials. So let's not be confusing life stage with true changes in behavior. There are true behavioral changes underway. I watched the time-pressed two-income couples. They are shifting how they buy and using free delivery as a means of clearing their home life to allow them to have an active work and a home life. That's real. The lack of driver's licenses per capita, that's real, but some other elements are likely going to play out a little differently than some might be expecting as demographic shifts occur. The U.S. is over-retailed. We have roughly double the amount of space per capita that Canada does, and 4 times the amount of space per capita that places like Germany and the UK and Australia have. That comes in part because of the competition. I'm sitting with a bunch of fine people that represent individual municipalities. The competition between municipalities for sales dollars has been a component of this overbuilding that is affecting all of us now. It's just a component of it, but it's one that should be noted. Long term, our conclusion about retail, and we still invest in retail. Retail is the strongest performer on a 25-year basis in institutional portfolios. We continue to think there's a future for it. But what we do anticipate is with entities like Bonton announcing or being forced into bankruptcy, as these anchors in regional malls go into bankruptcy, they trigger kick-out clauses that are going to mean that malls that have been limping along are going to move from limping along to the deadmalls.com website. There will be more and more of that. They will represent shadow supply today, but they will be gone. They won't go back to soybean fields, but they will be another use. Well, some of them might. And nature is taking over some of them. Just go to deadmalls.com for an extraordinary experience. True. Meanwhile, in the open air realm, we will see increasing densification. That's code for bringing non-retail uses into retail locations, helps generate foot traffic. So the best of the best will get densified. The others should be something else, some other type of use. The result is slower growth in tenant sales and market rents for the near to medium term for the survivors. And for the not survivors, they become an opportunity, one can only hope. But in the meanwhile, there is going to be tumult in this really interesting sector. Next slide. This is it's a really complicated chart that I love. It's trying to get to vacancy as it's a good indicator of the health in retail properties. Many of you have seen it before, but I'll take you through it one more time. Overall vacancy is shown in purple, and you read that off of the left-hand scale. Back to 2000, which is the starting point of the chart, you can see all centers. This is a combination, by the way, of open-air centers and regional malls. All centers saw their vacancy spike during the global financial crisis, and all centers aggregated together have seen vacancy come down to a national rate as of Q4 of 6.4%. But the nuance is the relevant part. The green line is centers with vacancy of 20% or more. As of year-end 2017, their average vacancy almost 50%. That's not going to allow them to survive. Retail tenants know that it's worth paying up to be adjacent to an entity that is bringing foot traffic into the center, and they will leave a failing center. For one, they'll pay more to be in a thriving center versus the failing center. And that's visible in the blue line, which is the vacancy rate for centers with vacancy of 20% or less as of year end. You can see those centers, that you're in blue, they saw a spike in vacancy during the global financial crisis as tenants went bankrupt across the quality spectrum of retail. But it's what's happened subsequently, where those centers now have an average vacancy of 2.3%. It's not a perfect environment. We're still not getting good rent growth in those centers, but that's temporary. Just got to wait long enough for enough of supply to come, or enough conversion, or enough true shuttering of the weaker retail. Next slide. I have 10 minutes. We're going to speed it up. Thank you. But I don't want to miss this. So I could whistle the theme song from Lassie for you if you'd like. I just want to make the point that retail has always been about change in retail, and this is on the tenant side, the store side. So there's the era of the clerks in the upper left. That gave way, starting in the early 1920s, late 1910s, to a system that was less about labor. In this scenario, upper left, people grabbed things to those clamps, those claws, and got them off of tall shelves for you. But what's his name? It's not Curtis Mayfield, but it begins with Curtis. I've forgotten his name. Mr. Piggly Wiggly. He came up with this notion of laying out a store such that there was one way in and one way out, and the reason it's called Piggly Wiggly is because of that. The layout is that fabulous. And with that, labor costs went down and customer pleasure presumably went up, though some grumbling no doubt was to be had. This is Whole Foods pre-Amazon. I don't know what Whole Foods looks like post-Amazon. I can't tell you that I'm really pleased with what's playing out at my local store. I'm happy. I'm hoping it's just a transition. But the mecca where you like the food and not the store, the great era of abundance in groceries. Anyway, next slide, please. Meanwhile, there have been changes over our lifetimes and a little beyond in the format of where we shop, okay? That's stayed in Madison, circa 1903, of course, in the upper left. The car. Initially, the province of the wealthy, it allowed for suburbanization. This, of course, Country Club Plaza. The pig theme continues. Country Club Plaza, Kansas City, an icon, a mecca, built on a former pig farm. How about that? So that was the early era of auto-oriented retail shopping. That gave way then after the car became lower cost enough for it to be the vehicle of the masses. That gave way to the big regional and super regional malls. And then over time here, this is a mall we own in Boulder, Colorado. It's become a mixture of high street and regional mall, evolving to allow for a shorter distance between parking and getting into the center. So the conclusion here is retail and retailers are always in the process of change, but throughout it all, next slide, Brad. I'm not going to dwell on this, but throughout it all, the centers that are best positioned to deliver NOI growth, hold their value, are the highest quality centers, worth paying up for that. Highest sales per square foot remains the single best metric in trying to figure out what the quality is of a center. Next slide. Moving into the warehouse realm, I call it industrial, but really what we're looking at is the dynamics in the warehouse market. Back to 2001, the red is completions, the blue is net absorption, and of course the yellow is vacancy rate. It peaked at about 10% in 2009, 2010. It's half that now. This is a sector that typically by this point in the cycle, we're seeing more supply being delivered than there is demand, but that's not the case. We've had supply lower level than demand for 7 consecutive years. Looks as though it's going forward. Next slide. This is, of course, all about the fact, as an example, Amazon's logistics network nationally 2 years ago was predicated upon the assumption that you would tolerate 2-day delivery. Huh. They were wrong. And as a result, they have to have more warehouse space closer in to us, expecting. In Tokyo, they're offering 90-minute delivery, as is the case in some urban areas in the U.S., and everybody has to compete with Amazon. So it's creating a massive upsurge in demand for warehouse space. Broadly speaking, the conclusion of this slide is in most locations, what's under construction is generally in line with how much space was absorbed over the prior 4 quarters. So we're not seeing any markets really getting out in front from a supply perspective. Next slide. And rents are holding up well. Here's Chicago at only 3.2%, so I spoke with one of my colleagues to find out why so low, because on the slide before, you would see that there's been more demand in Chicago over the last 4 quarters than supply is under construction. So it looks good. Likely what's happening here is the composition of what CoStar is looking at. As things happen like the Fulton market, the former industrial and warehouse space in Fulton market, that was pushing up the numbers on rent growth. Those were the in-demand, close-in restaurant locations, restaurant service locations. And as they give way to office and to retail, they're coming out of the inventory. And what's left driving this level of rent growth is the relatively low year-over-year rent increases in a place like Bolingbrook. We have so much land, warehouse rents can remain relatively low. Meanwhile, a little less, you've got places like the Inland Empire that have seen meaningful amounts of new supply for 4 or 5 years, but still seeing year-over-year rent growth of about 10%. Next up, moving into office, a different world. office is truly seeing disruptive technology play out. It's affected the amount of space per worker. It's affected the layout of offices. So what we're seeing here is a vacancy rate of 13.1% nationally, not terribly far off the peak, although this is the sector where the local level is least like the national level across markets. So there's a whole lot of variance, some very tight markets, as well as some markets, particularly suburban markets, I'm sorry to say. Non-transit oriented suburban submarkets are suffering in this downturn. A quick observation that doesn't really show through in the numbers yet. We're likely at the low point for amount of space per worker. The embrace of the open plan, the getting rid of the law libraries and other factors, they pretty much played through. The shrinking of law firms space per worker, that's pretty much played through. And it looks as though we're going to be seeing some expansion out in space per worker. There's also an increasing awareness now that we're 10 or 15 years into the embrace of the open plan that one size fits all doesn't work so well. There needs to be increasing array of space choices inside offices. One of my colleagues worked for JLL in Washington, D.C., just visited his old office where they've just moved to brand new space. He said it's a showroom for the office of the future. There's a cafe workspace. There's bench seating workspaces. There are places where you can retreat into chairs that are soundproof booths. So lots of recognition that we work differently. Maybe we don't want to be at our seats to collaborate. Maybe we want to do those in soundproof rooms as opposed to the collaboration that was forced on a lot of us. So there's a lot of change that's playing out in offices, and that includes where we want to office. It's been true since time immemorial, or the first office, which was, somebody here knows the answers to when the first office was built. But office is an execution or an indication of the brand of the company. So Amazon competes for its employees on the nature of its office space. So does Google. Similarly, Frank Lloyd Wright's design for the Ludgin company in Buffalo, that was about competing. And of course, the Johnson Wax building in Racine. It's not new, but it's definitely playing out at the era. We've lived long enough through this cycle that it is not the accounting departments that are determining office locational decisions, space decisions. It's the HR department that is. And that's showing up in the build out of space and in where within a downtown. If downtowns are the winners in this environment, where within downtown, it's about the live-work play settings like the Fulton Market that are seeing a significant upsurge in demand. Next slide. Let's jump over this quickly. This is office year-over-year rent growth, asking rent growth, but asking is basically the same as what you get at this moment in the cycle. It's growing at high rates and more in the tech markets. San Francisco and Raleigh top the list. Boston is the healthiest of the big markets right now. Let's move on. Although I will say here Chicago, 2.6% year-over-year growth. This is a metro average. Downtown doing better than the suburbs by and large. Next up. I'm going to skip through this one and go to a slide, one more slide. We are still in Chicago benefiting from the fact that in the center city, we've had a conversion of a lot of existing stock to other uses, be they hotel, residential, are two of the most common. That means that despite the delivery of the new Heinz building and the new O'Donnell building, which are between them 2.whatever million square feet, despite that, our inventory of office space metro-wide shrank by 1.6 million square feet over the 7-year period ending as of Q3. Really a benefit to the downtown as the amenity availability has been enhanced. Next slide. This is going to be my concluding slide. Many of you have heard me extol the virtues. In the U.S., we are lucky in that we have 8 meaningful property types to be able to invest in. Medical office, my current favorite, because in an environment in which there's so much capital chasing space, we have observed that secondary and tertiary markets for medical office are as liquid as the primary markets, and we can buy them on high yields, put a portfolio together of them, and sell them at a much lower yield 4 or 5 years later. So we remain quite bullish on the prospects for each of these property types with individual amounts, with nuance depending upon the property type. Going out with a whimper, not a bang, I'm sorry to say, but I'm going to conclude there to allow for time for questions. So, thank you for listening. So I'm happy to take any questions you might have. Is Ruth Wernma here? Ruth always likes to ask me the question I can't answer, but it looks as though somebody else will have to do that this year. Yes? David?
As I make my 3-year predictions, first, the Patriots win the Super Bowl in 2018 and beyond.
Will they deflate, though? It seemed only fair, right?
And 200 plus malls will close in the coming years.
Yeah.
Amazon will announce H22 at the old post office.
Oh.
Oprah will be elected president in 2020. And sorry, Cubs, Sox, Hawks, and Bears fans, it's going to be a very dismal period. What say you?
Oh, David, brilliantly done. And on the flyer, did you prepare that on the drive-in? That's really, that's great. Okay, so I'm going to leave that by itself. Marvelously done, but it won't be the Patriots. And do we want HQ2? Yes and no. Maybe. I don't know. My daughter is a college student in Seattle, and the culture has changed, let's say. So I don't know. Maybe we're big enough that the culture wouldn't change. But I guess I'd be happy to have the opportunity. Lawrence.
You can't argue with results, but why are you high on self-storage?
Thank you for that. So the reason I'm high on self-storage is when you lose your tenant in self-storage, your only operating cost is the amount of time it takes for somebody to sweep out the space. Or if it was Rod Blagojevich that was your tenant, literally, there was a Cranes article on this. The campaign had 3 storage lockers. They didn't pay the bill on it, so at some point there was the auction, and it included a full-size bust of Elvis. Right? How fabulous. When your tenants move out and they don't pay, you get to auction off their stuff. So that's a component. So the low operating cost versus what happens when you lose your office tenant, which likely has happened at just the wrong moment, such that you may be years away from somebody replacing that tenant that's unexpectedly vacant. So we like that part. We also like the fact that in storage, yeah, there's a recession impact. You've got 30-day leases, so your tenants can think to themselves as they're looking at their balance sheets and trying to remember what they've got in storage. They will some of your tenants will clean out their storage locker, and you will see a hit to occupancy, but in a recession. But within a few months, likely somebody's moving to take a new job and they're going to put some stuff in storage. Likely there's still going to be demographic shifts that happen. There's a college student that has to put the stuff in storage for the summer because they're going home. There's a death in the family, and that's a typical trigger for storage. So what we like about the storage sector is they're demand drivers that aren't solely related to the macro economy. And then finally, it's a sector that's in the midst of technological change, such that the early developers of storage were building in the 70s and the 80s. They often lived above the store. They ran it really well, but they can't compete in the era of internet search optimization and the technology that the big storage kahunas are using. And so they are selling to the big kahunas, and that's an interesting investment play where we can get a higher rate of NOI growth likely than they were getting. So thank you for giving me that chance. Yes?
So I saw a presentation that self-driving cars somewhere between 8 and 10 years away from being economically what the average family should do.
Yes.
How is that going to impact your retail predictions?
Retail specifically. I thought you might have been going to apartments. So the question is about self-driving cars. First, let me be a little I know there's changes coming. Change to my microphone included. So change is coming. I just don't firmly believe, and Jen Whitman has written a fine presentation on this, so we may have an interesting walk back to the office. I think it's going to be slower adoption than is being anticipated because of the complexity, particularly of the transition period, where you have a mix of self-driving trucks, which is where it's going to happen first, and autonomous cars, and the car driven by me, or worse still, the 18-year-old. Doesn't have her driver's license yet, and maybe she shouldn't, right? So I think we're not fully anticipating just how hard it's going to be, particularly in locations like Chicago. Self-driving, or any place that has weather, it's not an accident that Phoenix is where a lot of the exploration is being done, or Silicon Valley. It's not being done in Chicago. And you've got municipalities that are going to have to pay, I think, for the striping and the sensors. It would not be the first thing that, if I were running the city of Chicago, I would want to invest in versus repairing the bridges and the toll roads, or the roads, I should say. So I have a feeling it's going to be a longer implementation period than is being forecast. So how will it affect retail? Damned if I know. Is that an okay answer? What I do think is you're going to have a schism. It's going to, I believe, when self-driving cars actually come mode, you're going to have some people who use that as an opportunity to live in more dense urban settings where the parking lots are replaced with more affordable housing than we currently have. And there'll be others that will use the freedom to commute from Batavia or Wayne or other places that are, just to use the Chicago example, they're just a little hard to commute from today. So I think you're going to see it reinforce some settlement patterns. And that's about as far as I can take the real estate implications. I think we're going to have many years to figure out the real estate implications. That being said, would I buy a garage that's an asset where we're getting money out of a garage that has tilted floors? No. We're going to put a 0 on the assumption on income from there. We might be overly conservative, but. One more. Who will it be? Dan Martin? Forgive me. I'm going to go with Dan Martin. Hi, Dan.
Thanks, Mary. There is, going back to one of your very, very first points, there is, from Maine to Brownsville, there is untold billions of investment, particularly in resort properties. Just think about the skylines of places across Florida, but also Myrtle Beach, the Jersey Shore, everywhere. What are those people, how do you see those people responding to the climate change reality that's hitting them, where something like 180 cities are going to have routine flooding, in years to come?
Well, let's look at Houston. I don't know the exact facts, but you have, I believe there were 3 100-year floods in the run-up to Harvey. And there were people that put themselves on the list for a buyout from FEMA. Is it FEMA that does the buyouts? Help me with this. Go with me on this. Okay, you have people that are trying to respond in the prudent way to being in a flood zone, or to being realize that they weren't in a flood zone, but now they are. Now that the flood zone maps are being redrawn, so I think we're going to need to finance prudent decisions as a nation, and we have not historically done that. That's the simplest way to say it. People love water, we're drawn to it. The coastal locations are the highest value locations in a metro area, but we gotta understand the risks that are inherent in that. You also have to understand what's fill, as opposed to, hello, there we go. There are places like the Back Bay in Boston, David, that are fill, and they're at huge flooding risk, even though they appear to be land, and they're not coastal, right? But they're landfill. So we're going to have to understand as an industry the nuances of the location and just how possible it is for it to succeed going forward. You have locations like South Florida where it's simply a harder matter to protect them, given the coral undergirding as opposed to bedrock. In New York. New York will get? You don't know what I'm doing wrong. Yeah, love to. That didn't change my answer, and I don't quite what I was saying. New York. There are places you can bet will be defended like they're the Netherlands. And in other places where we're simply going to have to say, we cannot defend every element of the coast. So in making your real estate decisions, try to weigh what are the risks that you're taking. As a firm, what we're doing is we're not redlining areas, but we are looking at the portfolio level and saying there is a limit of how much of a portfolio we want to have exposed to wind or flood or hurricane or earthquake risk. And I think as an industry, that's going to be the way going forward. Luckily in Chicago, we seem to be beneficiaries in the access to fresh water and Lake Michigan levels are up, but not broadly speaking a problem. So with that, I will say, I hope I delivered on your behalf. Thank you so much for coming. I really appreciate it.